MMT, spend early, spend big, spend always. We're going to do something different with today's missive. Today, for the first time, we will allow a longtime reader, Era, the nature boy of finance, Flair, the Katusa research platform, to make his comments, which I believe are well thought out and go against what I've personally been writing about. Dear Marin, congrats on your book making #1 on the Wall Street Journal. It's a fantastic read. I wanted to share my thoughts on MMT, which you nailed in your chapter, but I feel you held back in your analysis. You did a great job explaining economist jargon into common sense, but I think we are a lot closer to MMT than you state, and the outcome will be much worse than you anticipate. Maybe it's because you are rich and happy, you don't see the world through the lens of the nature boy of finance. There's a virus sweeping across the United States. It's infecting politicians at the highest levels, completely changing how they think about new legislation. It suggests that the federal government can spend as much money as it wants. Spending will enable the government to grow the economy to its full capacity, get rid of unemployment, eliminate all student loans. Governmental policy decisions no longer need to be bound by considerations of the national debt. So it can create multi-trillion-dollar programs like free universal health care, free college tuition, and huge green energy programs. Infrastructure budgets? No problem. It's the ultimate solution. That magical solution is called modern monetary theory. It's the definition of a misnomer. It's not modern. It stems from chartalism, an economic school of thought from the early 1900s. It's not monetary. It takes place almost entirely through fiscal policy. More on that in a moment. And it's not a theory. It's been tried dozens of times over hundreds of years. Venezuela, Zimbabwe, Yugoslavia, Hungary, Greece, Germany, and it ended very poorly every time. All told, it's more archaic fiscal failure than anything. But this time, it will be different. Right, Marin? Yet politicians from both sides of the aisle and the economists at the highest levels are buying in. And they're doing so without knowing what it is. Not even the people running the show could describe MMT to you. I have not seen a carefully worked out description of MMT. That quote is by Jerome Powell, the chairman of the Federal Reserve. Even people who claim to know what MMT is, they don't even agree on the basic tenets. MMT is gaining ground fast, and it'll have a profound long-term effects on the global economy. You must know what MMT is and how it's going to affect you. Otherwise, investing in the future will be little more than a crapshoot. Like you wrote, Marin, in your recently published #1 bestseller on the Wall Street Journal and Amazon, and might I add, it was in the main overall category, not in some archaic niche category, The Rise of America, you broke down in great detail and in real talk, not economics jargon, what MMT really is. I recommend everyone not to be shy and read it and educate themselves. Here's a basic description of MMT theory from your book, Marin. Because the United States borrows in US dollars, it can always print more of those dollars to cover its debt. Under MMT, defaulting is impossible. Therefore, the government can run long-term budget deficits, racking up ever more debt without any negative long-term effects. Put simply, from a politician's perspective, though, the status of the US dollar means that the deficits and debt are not relevant to policy making by the United States government. It's a complete economic paradigm shift like we haven't seen in over 40 years. There ain't no such thing as a free lunch, Marin. To understand the future of MMT, let's take a step back. You'll recall from high school economics that there are two primary ways to control the U.S. economy. Monetary policy. The Federal Reserve controls the level of money and the credit in the economy by borrowing from and lending to other banks. Fiscal policy. Congress controls the level of money in the economy through taxation and spending. Generally speaking, the job of keeping inflation in check and managing economic growth belongs to the Fed. In times of crisis, the Fed's first tool is interest rates. Lowering interest rates to zero can quickly juice the economy by providing ultra-cheap credit, as you can see in the U.S. Federal Reserve target rate. Here's a chart from 1970. As you can see, interest rates have been steady decline for close to 40 years. Globalization, technological progress, and capital deepening amongst nations swallowed up most inflationary conditions. Bouts of economic decline were met with increased rate cutting, while times of prosperity never saw the previous cycle's high rate watermark. In the 2007 to 2009 global financial crisis, the Fed's testicular fortitude was tested. In the initial wave of the crisis, the Fed cut rates near zero, but it wasn't enough. So what did the Fed do when it backed into a corner? It created a shiny new tool. This tool was called quantitative easing, or QE for short. QE is a fancy term that refers to the Federal Reserve buying up government bonds in the open market to release cash into the economy. From September to November of 2008, the Federal Reserve printed money and bought $1.3 trillion worth of assets in the open market. As you can see from the graph below, it kept buying and buying and buying. That's the Federal Reserve balance sheet total assets. Between 2008 and 2014, the Federal Reserve's balance sheet grew by $3.5 trillion, with more dollars and asset prices naturally inflated. As the American economy began to strengthen, finally in late 2016, the Fed began to increase interest rates and in 2018 began to unwind its asset purchase. All told, the Fed unwound nearly $1 trillion of debt it had acquired. It should come as no surprise that the combination of rising interest rates and balance sheet sales led to periods of increased volatility. So, in 2019, the Fed resumed the buying program. It never stopped since. The spike in the chart that you're looking at above was in obviously COVID, when the Fed picked up another $4 trillion in assets with printed money. That's more than all of the asset purchases in the past combined. They're continuing to sweep up assets just to keep the floor from dropping out of the market. The problem with QE is that it gets less and less effective as more dollars are printed, a phenomenon known as diminishing marginal returns. So the Fed knew that they needed to get more creative. Bill Dudley, a Princeton scholar and head of the New York Fed for a decade, said, "It's not that the Fed can't do more, but doing more wouldn't do much." Any more interest rate droppings or QE, quantitative easing, would just be pushing on a string. All of which sets the stage for MMT. The rise of fiscal unilateralism, FU. We're seeing a historic handoff of power. Monetary policy as a means of economic management is completely giving way to fiscal policy. Congress is assuming comprehensive control of the business cycle and the US economy. That's the core of MMT, and it's inevitable. Granted, the current situation is FMC, Marin, the way you did detail in your book, but MMT is coming. Here's what it looks like when it's compared to what's been the case for the past 40 years. Basically, I've broken this down for you, Marin. The old method was during a recession, Fed cut rates. During the boom, Fed raises rates. In the FU model, government lowers taxes or spends more during a recession, and government raises taxes or spends less during a boom. Here's why FU policy, government spending, taxation, wage, and price control seems like a much more effective way of controlling the economy. It's fast. Think about how quickly you received and spent your stimulus check. Meanwhile, Fed actions take months or years to have an effect. It's cheap as long as the Fed keeps interest rates low, Congress can borrow rock bottom rates. Or more importantly, the Fed can print money. And through a convoluted mechanism, find any bills passed by Congress for free. It's targeted. Congress can choose specific areas of the economy based on who needs the most help. And it can create massive bills for infrastructure or send cash directly to people and businesses instead of the money just going to the big banks. Of course, all that spending means huge, record-breaking deficits. So that's the regime change. The fiscal rescues have grown bigger and bigger, and interest rate cuts ran out of the road. But the Fed is actually encouraging all of this, calling for more deficit spending by creatively picking up huge swaths of the debt that the Congress is creating and all but promising low borrowing costs for a long time. Jay Powell told the House Speaker Nancy Pelosi to think big, because interest rates are as low as they'll ever be. All right, it's Marin back here. So the nature boy of finance had some interesting points, and the point of this was to show that just because I believe in a framework, it doesn't mean I don't reassess my positions through other points of view. So that was interesting. I don't agree entirely, but what you should be asking is, how do you protect your portfolio? Whether you see the world as I do or as the nature boy, you need to focus on rule number 1, don't lose money. And rule 2 is don't forget about rule number 1. And rule 3 is then make money. So, what is Marin Katusa doing? I'm increasing my exposure to tactical growth opportunities along with exposure to gold and specific commodities. For example, opportunities that capitalize on the flood of money pouring into the ESG sector. Did you know that renewable energy is now the cheapest and most cost-efficient form of electricity generation? Or that carbon credits are becoming one of the most sought-after investment of major smart money funds? Fortune favors the bold but smiles upon the prepared. If you want to take the next step, consider becoming a subscriber to my premium research service, Katusa's Resource Opportunities. Every month, you'll see how I'm positioning my portfolio for the coming rise of America and the windfalls I see in coming specific sectors. I hope you'll join me. It's going to be an incredible adventure. Stay safe.